Investing has a set of 4 basic elements that investors use to break down a stock value. In this video, we will look at 4 commonly used ratios and what they can tell you about the stock. Financial ratios are powerful tools to help summarize financial statements and the health of company or enterprise. Hi there, welcome to Investor's Game. Today, we're gonna talk about how to calculate the value of a stock. And give us a thumbs up, that helps us a lot, so let's get started. First, we have to understand what is price to book ratio. The price to book ratio represents the value of the company if it's turned up and sold today. This is useful to know because many companies in major industry falter in terms of growth, but can still be a good value based on their assets. The book value usually includes equipment, buildings, land, and anything else that can be sold, including stocks, holding, and bonds. With purely financial firms, the book value can fluctuate with the markets as these stocks tend to move a portfolio of assets that goes up and down in value. Industrial companies tend to have more book value based more on physical assets, which depreciate year over year according to accounting rules. In either case, a low PB ratio can protect you, but only if it's accurate. This means an investor has to look deeper into actual assets making up the ratio. And how do you get this number? Well, it is very easy. Just Google the stock that you want to look for and then type PB ratio or price to book ratio. A good example is Apple. Its PB ratio of September is of 28.68. That means if the number is above 1, the stock is considered overvalued. So Apple, it's not a good idea to buy right now. We can wait when the PB ratio decreases to buy a stock for price. Next, price to earnings ratio. These measures of stock values tell you how much investors are willing to pay to receive $1 of the company's current earnings. Dividends a company's current stock price but its earnings per share, usually over the last 12 months, gives a company's trailing PE ratio. Dividend the stock price by forecast earnings from Wall Street analysts gives you a forward PE ratio. The reason for this is simple. A PE ratio can be thought of as how long a stock will take you to pay back your investment if there's no change in the business. A stock trading price at $20 per share with earnings of $2 per share has a PE ratio of 10, which is sometimes seen as meaning that you make your money back in 10 years if nothing changes. The reason stocks tend to move high PE ratio is that investors try to predict which stock will enjoy progressively larger earnings. An investor may buy stocks with a PE ratio of 30 if he or she thinks it will double in earnings every year. If this fails to happen, the stock will fall back down to a more reasonable PE ratio. If the stock does manage to double earnings, then it will likely continue to trade at high PE ratio. Here's some examples of PE ratio. Apple, for every $35 that you invest, you will receive $1. Amazon, for every $128 that you invest, you will receive $1. And Netflix, for every $84.70 that you invest, you will receive $1. Remember, we want this number as low as possible. A low PE ratio will allow you to invest more and receive more. The PEG ratio. Because the PE ratio isn't enough in and of itself, many investors use the price to earnings growth ratio. Instead of merely looking at the price and earnings, the PEG ratio incorporates the historical growth rate of the company's earnings. The PEG ratio is calculated by taking the PE ratio of a company and dividing it by the year-over-year growth rate of its earnings. The lower the value of your PEG ratio, the better the deal you will get in the stock's future estimates earnings. By comparing two stocks using the PEG ratio, you can see how much you are paying for growth in each case. A PEG of 1 means you're breaking even if growth continues as it has in the past. A PEG of 2 means you are paying twice as much for projected growth when comparing to a stock with a PEG of 1. This is speculative because there is no guarantee that growth will continue as it has in the past. Next, ROE, return on equity. It's a radio that provides investors with insight into how efficiently a company, or more specifically, its management team, is handling the money that shareholders have contributed to it. In other words, it measures the profitability of a corporation in relation to a stockholder's equity. The higher the ROE, the more efficient a company management is at generating income and growth from its equity financing. ROE is often used to compare a company to its competitors and the overall market. The formula is especially beneficial when comparing firms of the same industry, since it tends to give accurate indication of which companies are operating with greater financial efficiency and more the evaluation of nearly any company with primarily tangible rather than intangible assets. And what's the best number of ROI that we can look for it? The best will be 15, above 15 will be perfect. Next, debt to equity ratio. The debt to equity ratio shows the proportion of equity and debt a company is using to finance its assets, and it signals the extent to which shareholders' equity can fulfill obligations to creditors in the event a business declines. A low debt to equity ratio indicates a low amount of financing by debt via lenders versus funding through equity by shareholders. A higher ratio indicates that company is getting more of its financing by borrowing money, which subjects the company to potential risks if debt levels are too high. Simply put, the more a company operation rely on borrowed money, the greater the risk of bankruptcy if the business hits hard times. This is because minimum payments on loans must still be paid, even if a company has not profited enough to meet its obligation. For a highly leveraged company, sustaining earnings declines could lead to a financial distress or bankruptcy. Example of debt to equity ratio. Now, we can see the fiscal year ending of 2017. Apple had total liabilities of $241 billion and total shareholders' equity of $134 billion according to the 10-K statement. Again, this number we can get it just typing in Google debt to equity ratio of Apple. Okay. But in this example, the result of this is 1.8. And how we got this number? We got 241 billion divided 134 billion. Remember, the ratio doesn't give investors the complete picture. It's important to compare the ratio to similar company. For example, for the end of 2017, General Motors had to equity ratio of 5.03, far higher than Apple. Next, what is current ratio? The current ratio is a popular metric used across the industry to assess a company's short-term liquidity with respect to its available assets and pending liabilities. In other words, it reflects a company's ability to generate enough cash to pay off all its debt once they become due. It's used globally as a way to measure the overall financial health of a company. While the range of acceptable current ratios varies depending on specific industry types, a ratio between 1.5 and 3 is generally considered healthy. A ratio value lower than 1 may indicate liquidity problems for the company, though the company may still not face extreme crisis if it's able to secure other forms of financing. A ratio over 3 may indicate that the company is not using its current assets efficiently or is not managing its working capital properly. For example, the current ratio of Apple is at 1.8. That means that asset exceeds liability. Remember, below 1 means liability exceeds assets, above 1 means asset exceeds liability, above 3 means the company is holding cash. Next, dividend yield. It's always nice to have a backup when stocks growth falters. This is why dividend-paying stocks are attractive to many investors. Even when prices drop, you get a paycheck. The dividend yield shows how much of a payday you are getting for your money. By dividing the stock's annual dividend by the stock's price, you are getting a percentage. You can think of that percentage as an interest of your money, with the additional change at growth through the appreciation of the stock. Although simply on paper, there are some things to watch for the dividend yield. Inconsistent dividends or suspended payments in the past means that dividend yield can't be counted on. Like water, dividends can be ebb or flow. So knowing which way the tide is going, like whether dividend payments have increased year over year, is essential to make decisions to buy. Dividends also vary by industry, which often invest almost all their earnings back into companies to fuel growth, paying very little or no dividends. By combining these methods of evaluation, you can get a better view of a stock worth. Any one of these can be influenced by creating accounting, as can more complex ratios like cash flow. Why does intrinsic value matter to investors? Analysts use these methods to see if whether or not the intrinsic value of a security is higher or lower than its current market price, allowing them to categorize it as overvalue or undervalue. Typically, when calculating a stock intrinsic value, investors can determine an appropriate margin of safety, where the price is below the estimated intrinsic value by leaving as cushion between the lower market price and the price you believe it's worth. For instance, suppose in 1 year you find a company that you believe has a strong fundamental with excellent cash flow opportunities. That year, it trades at $10 per share, and after figuring out its value, you realize the intrinsic value is closer to $15 per share, a bargain of $5, assuming that you have a margin of safety about 35%. You would purchase this stock at $10 value. If intrinsic value drops by $3 a year later, you are still saving at least $2 for the initial intrinsic value and have some ample room to sell if the share price drops with it. For a beginner getting to know the market, intrinsic value is a vital concept. Remember when researching fears and finding bargains that fit within his or her investment objectives. Though no perfect indicator of success of a company, applying models that focus on fundamentals provides a sovereign perspective on the price of its shares. While calculating intrinsic value may not be a guaranteed way of mitigating all losses to your portfolio, it does provide a clear indication of a company's financial health, which is vital when picking stocks you intend on holding for the long term. Moreover, picking stocks with market prices below the intrinsic value can also help in saving money when you are building your portfolio. Although a stock may be climbing in price in one period, if it appears overvalued, it may be best to wait until the markets bring it down to below intrinsic value to realize a bargain. This not only saves you from the deeper losses, but allows you for wiggle room to allocate cash into other, more secure investment vehicles like bonds and T-bills. But I think here's the most important question. What do I consider it if I want to pick my stock? Well, first of all, we have to understand that any kind of market in the world comes with supply and demand. Knowing where is the supply and demand in the market will tell you where the price should be looking for a retest and get more buyers. Okay, let's go to the graph. Here, we're going to analyze Apple stock using supply and demand, and also we will use an indicator just to explain how intrinsic value works and why intrinsic value should go along with supply and demand. First of all, we have to identify where the prices stop to collect more buy positions. And what we're gonna do with this is that we're going to mark a demand zone, because we're trying to buy this stock. And look what happened when the market hit the zone and the intrinsic value was telling you the market was undervalued. Because on the intrinsic value of the stock is undervalued, that doesn't mean we should buy it right away. It's just telling us that the market is undervalued now and you have to look for a zone where buyers will be interested on buying Apple. So where do you think buyers bought Apple in this part? Exactly, in all around this zone that we marked before. It makes sense because intrinsic value says it's undervalued, and if we want to buy this stock, we have to wait for the best opportunity. So when Apple was dropping, we could calculate the intrinsic value of the company, identify the supply and demand zones, and then we can buy the stock. If you like this video, don't forget to hit the like button. Let me know in the comment box which radio do you think it's better for you and why. Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.